Let's move on now and let's address another set of earnings. And we've got Mr. Girish Kuski, the MD and CEO at PNB Housing Finance, joining in the studios right here. Mr. Kuski, great to have you today on ET Now. Firstly, give us a sense on where you actually see the demand and the slowdown, because what it seemed like what was a very rural specific problem is now sort of spreading to urban as well.
Good morning. Thanks for having me here. I think if you look at the industry and demand, demand is quite robust. So there is absolutely no slowdown, at least in mortgage industry. This year, if you see all the 3 quarters, first 9 months, there were some challenge or the other. There were a lot of intermittent challenges, nothing to do with demand. So we had general elections, we had heat wave, we have challenges in couple of states like Karnataka and MP on the registration process. We had election in Maharashtra, and there was some challenge in Chennai and Andhra with respect to climate. So because of these interventions, I think the growth till now seemed to be lower. But in terms of demand, irrespective of the segment, whether it is luxury, super luxury, or in terms of mortgage segments, super prime, prime, emerging and affordable, demand is quite robust.
Then where are the numbers?
I'm not, numbers are not there because of these reasons.
No,
so there was a slowdown.
The demand is robust. I'm just trying to, and not for you. I'm just saying for the industry.
Yeah.
The economy is growing at 8%. That's 7%. Chaliye, beech ka
Okay.
Right? Nominal GDP 11%.
Yeah.
The low-cost housing or the housing demand in India at a time when the real estate sector is in a boom is 10%. I was just hoping for better numbers. That's my limited point.
No, you're right. Numbers would have been better if these challenges were not there. All I'm trying to tell is that lower numbers is not because of the demand. Demand is quite intact. Okay. Look at PNB numbers. For example, you look at quarter 1, quarter 2, quarter 3, all the 3 quarters, we have almost surpassed our book target on retail. We had guided 17%, we are at 17.5%.
But sir, you had a low base also.
Not at all. Our base was,
if I compare with the industry average, today
the market is growing, it was last couple of years, market grew at 13 to 13.5%, right? Now, this year, till now, we have grown by 17.5%, which is about clearly 35 to 40% higher than market growth rate, right? Now, if you look at this year, it is projected that the growth would be 1% lower.
Okay.
So what used to be 13 to 14 could be 12 to 13.
10 to 11 is
exactly.
what we hear.
So all I'm trying to tell is that because we are seeing, for example, look at PMAY. This scheme was launched from 1st of September, 4 months from September till December. We have done close to 5,000 cases, 675 crores. Now this will stay for next 5 years, right? So all I'm trying to say is that numbers you will see little lower for the industry because of these reasons. Having said this, there is challenge in the economy, especially on some of the other segments. Rural is now starting to look up, right? So it will take another 3 to 4 quarters. If you look at, there is a lot of pain on the unsecured side. I think we've been witnessing since last 5 to 6 quarters. It will remain for next 3 to 4 quarters. If you see most of the banks, they have pressure on margin. I'm not taking away that point. All I'm trying to say is that mortgage industry, we are not seeing any slowdown. The slowdown this year in first 9 months is because of these intermittent reasons, which is temporary in nature.
Okay, my follow-up question is that everybody is now very conscious about what lending they are doing. We call it to know your customer. The bank is saying know your borrower, which I think is the best and the most ideal practice. Within that, everybody is now trying to only service the salaried class. And that's a conscious strategy which I've seen across all NBFCs and across all HFCs. Now, while on risk management, that is great. But for absolute growth, that is not great. Is that true?
It might be true, especially on the unsecured.
Okay.
It might be true with respect to banks.
Okay.
If you look at housing finance industry, look at affordable companies. Where are they getting yields from? They're getting yields from self-employed segment. So if you look at any affordable as an industry, I'm just guessing the numbers. Self-employed will be good 40 odd %, and some of the companies are close to 50%. So it also depends on the sector and the product, because mortgage is the most safest product.
Yes.
And you look at emerging self-employed is close to 40% for some of the companies. You take same PNB. Now, our share of self-employed now is over 35%. Salaried is 65. Yes, it is true that self-employed, the risk is slightly higher.
Yes.
Obviously, NPAs will be higher compared to salaried, but the yields will take care of the higher risk. So that is already factored in. The margins are slightly higher in self-employed because that is how the country will grow. That is how the industry will grow. On salaried, there's lot of competition. Almost all the banks, PSU and private, they focus on super prime and prime, largely salaried, easy to assess, credit risk is very low, but the margins are thin. It doesn't matter because for banks, mortgage is just one out of many products. But for housing industry, most of the companies are into monoline business. They have various segments, various profiles. So there you will see the right mix of salaried and self-employed. Otherwise, today, any housing finance company only focusing on super prime and prime would face huge challenge to be profitable.
But Girish, let's do the breakup of your book in terms of the lending as well, like you were mentioning, and correct me if I'm wrong. I believe that there's a cessation of the super prime schemes that you have, but in the prime segment you are still focusing, but it's the affordable that is doing very well for you. Your focusing is right there. There's a triple digit growth is what we are seeing. Help us with the understanding there that which is the key focus area right now and where are you going gung-ho about and what are the factors actually?
Sure. A very good question. If you look at PNB housing about 2.5 years back, we were predominantly focusing on super prime and prime, which means lower margin, which means low profitability. We had a large corporate book which was under stress. So little over 3 years back, we took a call that we will suspend doing corporate business. We will run down the book, work on the stressed pool and bring down the delinquency. Today, our corporate delinquency is 0. This we achieved 3 quarters back. Now, without corporate, only getting into super prime and prime for a HFC, it's a huge challenge in terms of profitability. So we took a call little over 2 years back that we will completely exit super prime. So we have completely exited. A. B. We started affordable in Jan 2023. We started with a modest disbursement of 5 crores, reached 100 crores in about 6 months' time. If you look at March 24, our book was 1790 crores in affordable. In first 9 months of the current financial year, we have doubled the book. Now the book is 3,838 crores. And we plan to take this book to 5,000 crores by March 25. So where are we talking about slowdown? Maybe the base is very small. I agree with you.
Yeah.
But if you look at most of the affordable companies today, don't take this year numbers. You take last year numbers. What is their quarterly disbursements? We are not very far off. Number one. Number two, we started emerging business this year. Why? Because affordable and emerging will get us a better margin. While we have a large book on prime, we can't completely exit prime. So we have a plan of exiting slowly, slowing down prime for next 3 to 4 years' time. So the plan is very simple. We want to focus more on affordable. Today the book is 3,838 crores. We want to get to 5,000 by March. We want to get to 15,000 crores of affordable book by FY27. Today the emerging book is about little over 13,000 crores. We want to take it to 25,000 crores by March 27. The overall retail book is going to be 1 lakh crore. Even in March 27, the prime is going to be 60,000 crores. But if you look at quarter 3, quarter 2 of this year, we have slowed down the growth rate in prime. Going forward, our growth rate in prime would be in single digit, maybe 9%. Emerging would be about 20+%. Affordable, the book is small, but we plan to reach 5,000 by March, maybe next year close to 10,000, by FY27 15,000. So that's our plan.
But in this segment, isn't there more a fear of slippages and NPAs? I know your numbers don't show that. Your NPAs are very, very stable, other than that one corporate account, which also I want to talk about whether you see, further NPAs from this particular account.
Sure. I think first let me talk about these segments.
Sure.
See, if you compare prime and emerging, emerging is slightly more riskier. If you compare emerging and affordable, affordable is more riskier. The credit cost is going to be different for these segments, but even the margins are different. So all these risks are covered. So absolutely there is no challenge unless the credit cycle changes. When the credit cycle changes, obviously you will see more stress in affordable, then followed by emerging and then prime. So that is already budgeted. Because of margins, all the companies, most of the housing finance companies, they are now focusing on affordable and emerging, or they have a mix of these segments. Now talking about corporate. Now I can't share the name.
You can.
But if you look at a book today is about 1241 crores.
So just say that again, how much is a book?
241.
1240 crores.
Okay.
Right. Now this account,
Okay.
which was in stage 1, has moved to stage 2. This account has been toggling between stage 1 and stage 2 since last 2 years. And in last 2 years, the principal amount has come down by 200 crores.
Okay.
So if we see the position we were in on this account, let's say 2 years back, 6 quarters back, and today we are in a far, far comfortable position. So there's nothing to worry. I think by this quarter end, we will see again this account coming back to stage 1. So that's the point on corporate.
Okay. 2-3 years ago, there was almost a war in the HFC space, led by PSU banks, SBI, PNB Housing, Can Bank. They said, look, we will give loan at 8.5%, 9%. If you buy before Diwali or Dussehra, we will even not charge you processing fee. If the woman in the house is buying, we'll give you additional 0.25% free. There was a war because that appeared to be the go-to space for everybody because, like you said, mortgage is very secure. But I don't see those big ads which are getting splashed now.
See, couple of
Is the war over?
Couple of things have changed. No, war is not over. Couple of things have changed. I'll tell you why. Now, most of the banks, they had a challenge on CD ratio. So they have to either increase deposits or reduce lending. Now, mortgage is a product within consumer loans, which will help to grow the book if you want to, also help you to reduce the book if you go slow on mortgage business. Now, I think most of the banks, it is my personal opinion, most of the banks, to correct the CD ratio, on one side they're trying to increase the deposits, which is hard to come by, at least till now we've seen a lot of challenges. What is the other option available? To go slow on lending. And within consumer, the easiest product, given the ticket size and the ease of doing business. When I say ease, the demand is quite robust and therefore ease.
Demand, safety, security, convenience, guarantee.
Secure product. So they're going slow on mortgage. That is the reason you will not see. Number one. Number two, any year, quarter one is cyclical. Why it is cyclical? Because quarter four, I don't know what happens. It's still a jinx. Entire industry does well.
It's a government spending. It's a government spending, so, year-end closure, everything comes together.
So after quarter four, quarter one will be soft.
Okay.
It will be muted. Now quarter two will be very good. Quarter three for housing finance companies is little tricky.
Quarter three.
Why?
Quarter three is little tricky because all the companies products focused on consumer will do well. For example, wheels business. For example, unsecured. These products will do well because the spend goes up because of festive season.
Diwali, Dussehra.
Whereas for mortgage industry, if you see, number of holidays in quarter three is the highest. Now that actually impacts. So therefore, quarter one and quarter three is little muted. Quarter three is tricky. Quarter one is more cyclical. Whereas quarter two will be good and quarter four will be excellent. I think that is the trend. And this year, why it is low? It's because of these reasons.
One more question.
Sorry.
No, one more question, at least before we wrap. One decisive trend is that real estate prices have gone up by at least 50 to 70% across India. But if I look at the profile of home loan companies, the bracket in which they have loans which are bracketed between 25 lakh to 50 lakh or 50 lakh to 1 crore, despite such a large boom, that quantum has not increased. What I'm trying to say is that let's say in 2021, if for the industry the average loan size was sub 50 lakh rupees, while real estate prices have doubled in India in the last 3-4 years, that average ticket size has only gone up by 25%. Am I missing on something?
In some markets, you're right. I think the rates have really increased. But if you take overall, what happened during COVID, prices crashed, which was because of an event called COVID. Prices crashed. Post 2020 October, real estate space started recovering. Prices start going up. So whatever 60-70% increase, what you're saying, the real increase is quite less because it had already dropped during COVID period. Number one. Number two, today what is happening is that there is a lot of balance transfers. So we have 4 segments. So all the affordable customers, once they improve their credit score, they would migrate to emerging, which means they would shift to some other institution, and emerging to prime, and eventually prime to super prime, which is obviously the top few banks in the country. So there is a migration process. So I think at least about 20% of what business we do every year, it is just rotating from one institution to other institution, and that is why you will see that the growth is still at 13-14%, and with this PMAY, I think it might inch up from coming year because there's huge demand for that space, which would aid companies focusing on affordable and emerging to a small extent in prime, given the ticket size. So you will see that from coming year. This year, because of these challenges, you will not see even the growth rate being maintained what we saw for last 2 years.
But so what's your expectation on the interest rate trajectory and anything additional that may come by in the budget?
I think we've been discussing about rate cuts since last 3 to 4 quarters, and it will happen sooner than later. So probably I'm expecting a 25 bips cut, to start with, because even now there's a dilemma, looking at inflation, looking at, right. So I'm expecting 25 bips cut.
But you're not expecting any impact on your NIMs because of that?
See, 25 bips rate cut would impact 10% on cost of borrowings. So we'll be able to pass on that. So we'll be able to maintain that in short to medium term. And after that, with this mix change, it should improve.
Right. Okay, Mr. Kusgi, such a pleasure having you on the studio today. Thank you so much for your time.
Thank you.
Okay.
If you like this video, then like, share and subscribe to ET Now.